in case of fraud, we have got 4 topics to cover, 4 major heads to cover. And what are the heads? That yes, we need to cover the basics, which we have already done. Now we are going to start with essay 240. But let me tell you again, guys, that with respect to fraud, we have certain more topics which we are going to cover in the later chapters. Okay, so for the timing, I have incorporated only these 2 parts in chapter 5. And this will be section 143.12. This is with respect to fraud reporting. We are going to cover in the company audit part. Okay, all right. So let us start with essay 240. The name of this standard is the auditor's responsibility relating to fraud in an audit of financial statement. The auditor's responsibility relating to fraud, okay, in an audit of financial statement. So we have already discussed the basics. I told you the responsibility part, and because of inherent limitations of audit, we are not in a position to detect all misstatements. Okay, so what is our responsibility towards the fraud? So our responsibility, you just have to remember this line, that detection of fraud and error is not the duty of the auditor, provided that he proves that he complies with the requirements of the standards, he maintains professional skepticism throughout the audit, and is not grossly negligent in performing his duties. So if he is able to prove all this, he will not be held liable. Okay, all right. Now let us understand the requirements of essay 240. Okay, what is but before again requirements, let us first understand why this, what is the standard, what is the purpose for this standard, why is this standard there in our syllabus, why this standard needs to be complied with by the auditor. So this standard is going to help us in basically doing 3 things. The objectives of the auditor are, you only have to read it, okay, to identify and assess the risk of material misstatement. So this standard will basically help us in detecting ROMMS because of fraud, to identify and assess the risk of material misstatement in the financial statements due to fraud, specifically due to fraud. Then to obtain sufficient and appropriate audit evidence about the assessed risk of material misstatement. Whatever evidence, whatever RMMS we have obtained, we are going to try and obtain sufficient appropriate audit evidence with respect to the fraud. Okay, and finally, to respond appropriately, how are we going to respond to the identified or suspected fraud? Please remember, now you know which is the standard wherein we identify ROMMS. Tell me the name of the standard. Is ROMMS. It says to identify and assess ROMMS. This is done as per 315. You remember the name of 315? Identifying and assessing the risk of material misstatement through understanding the entity and its environment. So whenever we determine ROMMS, it is done using essay 315. But we are more concerned with ROMMS with respect to fraud. Okay, once the ROMMS is determined, okay, I told you, on the basis of ROMMS, what do? We basically, as an auditor, we try to find, we basically determine the nature, timing and extent of our further audit procedure. So as per the risk determined here, we design our procedures. So if the risk is more, we do more audit. Okay, so ROMMS is determined as per 315, and how much further procedures do we have to do? How do we respond to this risk? This risk is basically as per essay 330. Okay, so if you can see now, it says to obtain sufficient appropriate audit evidence about the assessed risk of material misstatement. Whatever risk you had assessed as per 315, we are now going to obtain sufficient appropriate audit evidence regarding this. This will be obviously done as per 330. 330 tells us further audit procedure. Okay, in short, RAP. In short, when we do RAP, it is 315. When we are doing FAP, it is what? 330. Okay, and apart from these 2 things, if we identify any fraud, how are we going to deal with it? How do we respond to identified or suspected fraud is what we are going to learn in this standard. Okay, so you don't have to go through the objectives, it is just for your understanding. Okay, now let us come to the requirements part of the standard. Requirements part means that these requirements are legally enforceable. This the auditor needs to comply with. Okay, now first requirement of 240. This was a requirement of 200 also, that the auditor is going to maintain an attitude of professional skepticism throughout the audit. Do you agree with this or not? We covered the concept of professional skepticism in essay 200. So here also the first requirement of 240 says the auditor should maintain an attitude of professional skepticism throughout the audit, recognizing he should be alert, he should be vigilant specifically towards fraud. Okay, so he should maintain an attitude of professional skepticism throughout the audit, recognizing the possibility that a material misstatement due to fraud could exist. Okay, notwithstanding the auditor's past experience with the entity and about the honesty and integrity of the management. Let's say we have been auditing an entity for past 2-3 years. The entity management or the owners portrays that they are very humble, they are very honest, etc. But please ignore this fact. You just don't keep this thing in mind that yeah, these are honest people, they are not going to indulge in any fraud. You have to be always alert. Ignore this fact. It says notwithstanding the auditor's past experience with the entity about the honesty and integrity of the management. You have to be alert even though let's say they are very honest. So professional, just one point you have to understand here. Till this part you can understand. Okay, this part. The auditor should maintain an attitude of professional skepticism throughout the audit, recognizing the possibility that a material misstatement due to fraud could exist. Okay, all right. Now, second point. What is the second requirement of the auditor here? Let us go through it. It says discussion among the engagement team. Discussion among the engagement team. Do you remember the word engagement team? What is a who are the members of the engagement team? There will be one partner, there will be articles, okay, let's say junior chartered, okay. So the engagement team is the team that actually goes and performs the audit, okay. So there has to be a discussion amongst the member of the engagement team. Discussion among the engagement team. Members of the engagement team members should discuss the susceptibility of the entity's financial statement to material misstatement due to fraud. That means susceptibility simply means chances. We need to discuss among ourselves that okay, what are the chances that management must have done fraud in the company? What are the chances of financial statements being materially misstated due to fraud? We need to discuss this aspect, okay. And once we are discussing this aspect, obviously we will identify those particular elements of the financial statements where fraud could have happened. Let's say in case of banks, majority of the fraud might happen, let's say in case of loans. So as an auditor, will first discuss with my team that what do you think? Can the bank engage in fraud? If yes, okay, if they do engage, what are the areas wherein the fraud can be committed? We need to discuss these aspects with our team, okay. So that this discussion shall take place, particular emphasis on how and where the entity's financial statement may be susceptible to material misstatement due to fraud. That means where can the fraud happen? Okay, so we need to discuss that yes, if there are chances, we need to discuss, and okay, if there are chances, where in the financial statements particularly are the chances of fraud likely to happen, we are going to discuss this amongst ourselves. Okay, so this is the basic two requirements. Then after doing this, okay, we are going to do a risk assessment procedure, RAP, and related activities. RAP will give us what? You all know, doing RAP is done as per 315. What does RAP gives us? Yes, it gives us ROMS. So in this particular case, we are doing an RAP to determine ROMS with respect to ROMS because of fraud. So we are doing an RAP to determine ROMS relating to fraud because of fraud. Okay, so what are the things that we are going to do here? This can be an important question here. Explain the risk assessment procedures and related activities as per SA 240. So you have to first understand, okay, that by doing RAP, the auditor comes up with ROMS, and because they are mentioning that in the question it is mentioned that we have to answer RAP in accordance with 240. That means what all things the auditor is going to do to determine the ROMS because of fraud. So first point, he is going to inquire with the management and others within the entity. Then he is also going to inquire with TCWG. Okay. Then he is going to detect some unusual or unexpected relationships. He is going to find, if you remember, analytical procedures. Before the audit starts, he does an analytical procedure to detect fluctuations. So now if there are a lot of fluctuations, if there is fluctuation in one particular element, he is going to be more focused in that particular area while doing the audit. Okay, then some points with respect to other information, and then evaluation of fraud risk factors. Fraud risk factors, we just covered the three words. What are the fraud risk factors? Incentive, or let's say pressure, then opportunities, and then attitude or rationalization. So these are the things which the auditor will be checking or will be seeing, I can say, and I'll call them as risk assessment procedure. It is going to give an idea to the auditor with respect to ROMS arising out of fraud. So, okay, so let us read the topic, and this is an important question. This, I feel, if at all a question is framed from essay 240, either it will be from this part, mostly it will be from this part only, or else from this part. Okay, we are going to cover. So, what are the 5 points? Okay, 5 points within RAP. First is inquiring management and others within the entity. What is the auditor going to ask? Okay, now please answer this question to me. Whose responsibility is it whose primary responsibility is it to prevent and detect fraud? Yeah, so we are going to ask management first. We are going to inquire management that management, do you have a process in place wherein you assess the chances of fraud? Okay, so, or have you assessed the likelihood of fraud in your organization? So the first thing which I am going to inquire is about management's assessment of the risk that financial statements may be materially misstated due to fraud. So management, do you do an assessment or not? Okay, all right. So if you do, I want to know your process, management's process for identifying and responding to the fraud. So first is what we'll see, whether management does an assessment. If they do, how they do it, management's process for identifying and responding to the risk of fraud. Okay, first 2 points clear. Okay, then let's say a fraud was detected. So whether the management communicates the fraud to higher authorities or to the concerned employees. So point with respect to communication, management's communication. 2 points with respect to communication, if you can see. Now, management's communication, if any, but this communication is with whom? TCWG, regarding its processes for identifying and communication and responding to risk of fraud. So management's communication with respect to with whom? TCWG. What are they going to communicate? They are going to communicate this, that yeah, this is their process for identifying and responding to fraud. Again, management's communication to employees regarding its views on practices and ethical requirements. So this is a communication with respect to with whom? With employees. Okay, and for those entities that have an internal audit function. Now please, again, logic. Let's come to the logic. If let's say we have an internal audit department in the organization, then what is going to happen to internal controls? The chances of internal controls being adequate, will it be high or low? If there is an internal audit department, what do you think? Yeah, obviously the internal control will be high. And don't you think the internal audit department will also be knowing about a fraud that might have happened in the organization? Yes or no? So, as an auditor, the heading says we are going to inquire management, inquiring from the management and others. By others, I mean internal auditors. So, you are also going to inquire from the internal auditors whether they are aware, whether it has knowledge of any actual suspected or alleged fraud. Okay, whether they have knowledge about any actual suspected or alleged fraud. Alright, so okay, done. So, what are the things that the management is that the auditor is going to inquire of the management? Management, whether you have assessed or not, whether you have made any assessment regarding the existence of fraud. Do you have a process in place for identifying and assessing the fraud? Okay, have you communicated about the process to the management? Have you communicated regarding keeping of culture of honesty and ethical values to the employees or not? Okay, and I may even go and inquire from the internal audit department or function whether they have knowledge about any fraud which is, let's say, which has been committed, or whether they have knowledge about any suspected fraud. Okay, so this is how I'm going to inquire from these people. Okay, now I'm also going to make an inquiry from the TCWG whether TCWG is aware about any fraud. Okay, so the next point is the auditor shall obtain an understanding of how TCWG exercise oversight of management process for identifying and responding to the risk of fraud in the entity. So please understand, in this point, management was responsible for communicating their process to TCWG. Okay, but now at the same time, I also need to see whether TCWG is keeping an eye on the management's process, whether they act as an oversight mechanism to the work of the management with respect to fraud. Okay, so we have a point here, whether they exercise the oversight mechanism, whether they exercise oversight on what? Whether they keep an eye on the management's process for identifying and responding to the risk. Okay, and I shall also be asking them whether they have any knowledge of actual suspected or alleged fraud affecting the entity. So what are the 2 things I am going to ask to the TCWG? Whether TCWG, are you keeping an eye on the management's process with respect to identification and assessment of fraud? Secondly, I'm going to ask them TCWG, are you aware of any fraud that has happened or is about to happen, or let's say suspected fraud? These are the two things I'm going to inquire from TCWG. Okay, what all inquiries do I need to make to the management? 5 points. 5 points. Management 5 points. What are the 5 points? I'm going to ask them about their assessment. I'm going to ask them about their processes with respect to identification of fraud. I'm going to ask them whether you have communicated about your process to TCWG. Okay, I'm going to ask them whether you have communicated your policies, code of conduct, etc., the need to maintain honest culture and ethical values to the employees. And I can also inquire from internal audit department whether they have any knowledge with respect to fraud, suspected fraud. Okay, then the inquiry with TCWG done. Then what is the next thing that I might do? See, I told you in analytical procedure, if you remember, analytical procedure is done at 3 stages. It is done during the planning phase of the audit, before you actually start the audit. It is done during the substantive procedures, obviously when we perform the audit. And thirdly, before I conclude the audit, during the final stages, I am just about to sign the audit report, but I still check the ratios, whether they are in consistency with my expectations. Okay, so 3 places where we do analytical procedures. Now, during the planning phase, why do we calculate all the ratios and all? So that we determine the fluctuations. We calculate ratios, we compare them with the previous year. If there are unusual fluctuations, this indicates basically that there might be some misstatement. So I'll focus on these fluctuations more during the audit. Okay, so third point, RAP. If the auditor finds, please now understand, if the auditor finds that there are fluctuations, will the ROMMS increase or not? Will he do more procedures in the audit or not? Yes or no? Yes. Okay, so when the auditor finds unusual or unexpected relationships, read the point, just write AP here. AP means analytical procedure. The auditor shall evaluate whether unusual or unexpected relationships that have been identified in performing analytical procedures, including those relevant to revenue accounts, may indicate risk of material misstatement due to fraud. Now what happens, please understand. Auditor does analytical procedure when? In the planning stage. He does analytical procedure in the planning stage. Let's say he identifies fluctuations. Let's say there are fluctuations. I write yes, fluctuations. Again, there are fluctuations. Now what is the next thing? That this means what is going to happen? ROMMS is there. Okay. Now the auditor needs to assess whether these ROMMS are because of fraud, whether the chances of these ROMMS is because of fraud, whether there are misstatements in the financial statement that has been intentionally done. The auditor needs to assess this. Okay, so you all know this, right? That this sequence, you know, that audit analytical procedure perform. If there are fluctuations, obviously ROMMS increases, but the auditor needs to assess. Read the line again. He needs to evaluate whether unusual or unexpected relationships that have been identified by performing analytical procedures include those related to revenue accounts, which indicates that yes, the risk of material misstatement is due to fraud. If there are fluctuations in revenue accounts, this might indicate that they have purposefully there are intentional misstatements. That means ROMMS is on account of fraud. He needs to evaluate this. Okay. Then what all other information he needs to obtain? The auditor shall consider whether other information obtained by the auditor indicates risk of material misstatement due to fraud. Now what can be the other information? What can be the other information? Let's say we find some contradictory evidence. Okay, let's say okay, or let's say I can also write similar industry information. Write the example, similar industry information. I do the audit of a similar company wherein the cost of goods sold is completely different, and they have completely different cost of goods sold or any other figure. Okay, so what can happen? Similar industry information can give us an idea, okay, whether there are some chances of misstatements due to fraud, etc. Okay, and the last point, evaluation of fraud risk factors. I have already told you what the fraud risk factors are. It can be incentive, pressure, opportunity, or rationalization, attitude. Okay, so the auditor shall evaluate whether the information obtained from other risk assessment procedures and related activities performed indicates that one or more fraud risk factors are present. So I need to assess the fraud risk factors also. Okay, so these are the 5 points. Please remember, I feel that this is an important question. If they ask a question directly from 240, as such the chances are very slim, but still if they ask you a question directly from 240, it is going to be explain the risk assessment procedures with respect to 240. So 5 heads you have to understand. inquiring of the management, inquiring of TCWG, analytical procedures, other information, and determining or evaluating the fraud risk factors. Fraud risk factors. Is the topic clear to everyone? Yes. So again, please understand. See, we have done RAP, and on the basis of which we have assessed the ROMMS. Now, do you remember in 315? In 315, I told that ROMMS is determined at 2 levels. Can you name those 2 levels? Can you name those 2 levels? Don't you think ROMMS is determined at the financial statement level as a whole? And then I told you it is determined at assertion level also. What example did I give you there? Can you name some risk from material misstatement at the financial statement as a whole? If there is going concern, fraud, I told you, yeah, because fraud will impact a lot of estimates, a lot of transactions. Okay, fraud, going concern, profitability, these are all examples of misstatements at the financial statement level. But let's say we are talking about only inventory, only with respect to debtors, 1 or 2 class of transaction. This is with respect to, this is basically risk of material misstatement at the assertion level. Now, in this particular chapter, because we are more concerned about ROMMS with respect to fraud, so auditor needs to determine ROMMS arising out of fraud also at these 2 levels. Okay, so let's understand the point. Identification and assessment of risk of material misstatement due to fraud. Okay, so in accordance with 315, the auditor shall identify and assess the risk of material misstatement due to fraud, again at the financial statement level and at the assertion level, for classes of transaction, account balance, and disclosure. Now let's say, if I say, okay, if I say, for example, management overrides the control. A lot of controls has been, management has override the controls. Okay, if I say management overrides the accounting control, overrides accounting control. Now when the controls on accounting part has, let's say it has, management has overridden all the, let's say, accounting controls. Now this might impact many assertions. So this is going to be ROMMS due to fraud at the financial statement level. Okay, and if I say assertion level, now please give me an example for this. Yes, can you give an example? Can I say that purchase price, let's say the purchases has been inflated. Why? So that I receive kickbacks, so that management receives, let's say, kickbacks. I told you about this. Kickbacks from whom? From supplier. So rather than making a purchase of 50,000, I actually make a purchase of 50,000 by I pay you 1 lakh, so that you return me the 50,000 and it goes into my pocket. Okay. So if something like this happened, now this is an ROMMS at the assertion level. Fraud has happened in the purchases, transaction of purchase. So this is fraud with respect to assertion level. Okay. So what I'm trying to tell you is, as per 315, you have already studied this. ROMMS, be it because of fraud or error, you have to determine it at 2 levels. But now because we are covering 240 and we are more concerned with ROMMS due to fraud here, so for ROMMS due to fraud also, you need to find ROMMS at 2 levels. One is the financial statement level and the other one is assertion level. Okay, the auditor shall, based on a presumption that there are risks of fraud in the revenue recognition, evaluate which type of revenue transaction or assertion gives rise to such risk. So this is not very important. First line is sufficient. You just read this. Okay. Now, having assessed, please understand now, having assessed, let's say, the ROMMS, having identified and assessed ROMMS at 2 levels, what is the auditor going to do now? He is going to respond to these risks. How is he going to respond to these risks? By doing what? By applying procedures. Which procedures? Can anyone answer? By applying procedures. So we do an RAP here, we get ROMMS. Now on the basis of the risk, I am going to apply procedures. What are the procedures? Basically I am going to do further audit procedure. That means substantive procedures, test of controls, etc. Okay, and you all know FAP is done in accordance with what? 330. So RMMS I determined and I respond to those risks by doing an FAP. If the risk is very high, I do more FAP. If the risk is, let's say, relatively low, less FAP will also be able to bring my audit risk to an acceptably low level. Is this clear to everyone? You determine the risk and then you respond to risk. Do you understand the word responding to risk? We are not mitigating the risk here. Implementation of controls is responsibility of management. When I say response to this risk, this means how can I reduce the ROMMS? When I say respond to this risk, means how can I reduce my audit risk to an acceptably low level? Is this clear to everyone? Yes? Okay. So how am I going to respond? So we have, see, for the ROMMS that prevails at the financial statement level, so I am going to develop overall response. It says, in accordance with 330, the auditor shall determine overall responses to address assess risk of material misstatement at the financial statement level, and then response at the assertion level. For ROMMS at the assertion level, we are going to draw procedures. We are going to apply procedures for that assertion. It is very simple. So simple point, for the ROMMS at the financial statement level, we are going to have some overall response. We need to apply procedures on overall. Okay. Secondly, for ROMMS at assertion level, we need to apply procedures for that assertion. Very simple. So response at the assertion level, in accordance with 330, the auditor shall design and perform further audit procedures. See, the word is further audit procedure, whose nature, time and extent are responsive to the assessed risk of material misstatement due to fraud at assertion level. Okay. Alright. So nothing to study as such here. Now this point, response to risk related to management override of controls. When I see that yes, management has override the controls. Okay. So what all I need to do here? Okay. So the point here is management is always in a unique position to perpetrate fraud. They can always indulge in a fraud because of the management's ability to manipulate accounting records and prepare fraudulent financial reports statements by overriding the controls. Okay. So management is always in a position they can override the controls. Okay. And if it is a risk of material misstatement due to fraud and does a significant risk. Do you remember the word significant risk? In 315, essay 315, I told you that when you come up with various risks, let's say R1, R2, R3, this way you, let's say, go up to 10 risk. Okay. Then I told you need to prioritize the risk. Okay. And I, let's say, told you that risk number 3 and let's say risk number 10 are very, the auditor prioritizes them. So these will be known as what? Significant risk. Okay. And how does the auditor deal with the significant risk? Do you remember? He gives what does he do here? Yeah, exactly. This word, special audit consideration. Special audit consideration. Okay. And guys, if you remember now, in essay 315, we had a topic. If you remember, let me take you back to the topic. How will the auditor determine whether a particular risk is a significant risk? We came up with some factors. Okay. There were 6 factors, if you remember. 6 factors. Okay. And I told you that first factor is on account of fraud. Okay. Then let's say some developments, some changes. The other point was with respect to some recent developments or changes. Okay. Then there were points with respect to transactions. Any transaction, 3 transactions we had covered. Okay. If you are not able to recall, let me take you back to the chapter. Okay. Yes, this is an important point here. So 315, the 6 factors, so that you are able to recall what am I actually referring to. I told you that there is fraud, there are developments or changes, subjectivity involved, then 3 points with respect to transactions. That lot of complex transaction is there, transaction is with related parties and transaction outside the normal course of business. So this factors help us in determining the risk which are actually significant in nature, significant risk. Okay. So now coming back to the topic, what if the auditor, the point here is the auditor needs to understand that the risk of material misstatement due to fraud, and thus it is a significant risk, and the auditor shall determine whether the audit needs to perform extra audit procedure. You all know that when there is a significant audit risk, the auditor needs to pay special audit consideration. He needs to apply special audit consideration to those areas. So the auditor will assess that whenever there are chances of misstatement due to the fact that management has override the controls, he needs to see whether it is a significant risk, and obviously it is going to be a significant risk because of fraud, and he needs to apply special audit procedures, special audit consideration. That's it. Okay. So we are done with the almost, we are marching towards the end of the standard. Only point which I want all of you to understand, at the inter level, they are more concerned with the basics, that whose responsibility is to maintain, to detect and prevent fraud. Okay, why will the auditor not be able to detect all the frauds, and all these things they will ask you. And if they ask you a question, please mark this as important. I feel this is really, really important. Okay, but now last point is auditor unable to complete the engagement. Last point. Okay, now just see, if let's say as a result of misstatement resulting from fraud or suspected fraud, the auditor encounters exceptional circumstances that bring into the question the auditor's ability to continue performing the audit. Okay, so he may think of withdrawing from the engagement. So auditor, if there is a lot of fraud involved, he may not continue with the auditor, but if he leaves the engagement, he needs to perform, he might have some duty to inform regarding the fraud to appropriate persons. Okay, so the point here is determine the professional and legal responsibilities applicable in the circumstances. Like for example, section I told you 143(12) of the Companies Act tells us that in case of fraud which exceeds, let's say, 1 crore rupee, the auditor needs to report to the central government. So this is a professional duty here. So when, let's say, you have found a fraud in the company, there is a misstatement because of fraud in the company, you need to now check your professional and legal responsibilities applicable in the circumstances. Do we need to report to the regulatory authorities or not? Regulatory authorities means ROC, MCA, etc. Okay, and then you can think about whether it is appropriate to withdraw from the engagement, where withdrawal from the engagement is legally permitted. Now, can you leave the engagement? Okay, but now let's say in India, if you do the audit and you find a fraud, you complain about it, you give a intimation about it under section 143(12) to the central government also, and obviously you can now give an adverse opinion. Okay, but in some countries, let's say the management is not letting us work because we have found a fraud, and also in some countries they let you withdraw from the engagement also. Okay, you can leave the engagement, and obviously, but you have to, even if you leave, you have to basically understand and comply with any professional or legal duties that you are bound with. For example, in India, we have to report to the central government in section 143(12). We have to report about the fraud in Caro also. Caro is a special report. Caro is a report which we are going to cover in audit report chapter. Okay, and then if the auditor, let's say, is allowed to withdraw, and if he withdraws, obviously before leaving the engagement, he is going to discuss with the appropriate level of management and those charged with governance the auditor's withdrawal from the engagement and the reasons for withdrawal. So you are not going, we are respectable, we are professionals. Okay, even if we leave the engagement, we are going to tell that there's a clear case of fraud here, and because of this we are leaving the organization. So you are going to discuss with the management and TCWG and determine whether there is a need, there is a professional or legal requirement to report again. So once you are leaving also, once you are resigning, let's say, from the work, you need to again see whether on resignation you need to report. So in India also, on resignation you need to report to the MC in ADT 3, in form ADT 3, and when we report, we obviously state the reasons what is the reason that you are resigning. Okay, so this is the point that you have to cover. So what did I tell you? Let's say if there is a fraud, okay, so what is the first thing the auditor needs to do? He needs to check on his professional duties, whether there is a need to report regarding the fraud to some regulatory authorities. And he can also, if he wishes to leave, whether he is allowed by the law to leave the engagement, or I can say to withdraw from the engagement. Okay, now if he withdraws, let's say if he withdraws, he is not going to withdraw randomly. He is going to discuss the reasons with the management and TCWG, and he needs to comply with some regulatory requirements upon resignation. So he needs to, let's say if it is a company, he needs to file ADT 3, and in ADT 3 he needs to state the reasons of his withdrawal. He needs to state the reasons why is he resigning, or let's say quitting or withdrawing from the engagement. Okay, so guys, this is all about essay 240. Again, Again, I am telling you what is the thing that you have to understand in this standard, the requirements. First is professional skepticism. Only one point that the auditor needs to be aware throughout the audit with respect to fraud. Second, if we need to be updated, we need to discuss with our engagement team about the chances of fraud, where in the financial statements the fraud can happen. Third, we do the RAP. This is the question that can be asked, that what are the procedures, what risk assessment procedures the auditor will do in order to determine ROMS due to fraud, or what risk assessment procedures are required as per SA 240. So 5 points: inquiry with the management, inquiry with TCWG, analytical procedures, other information, and fraud risk factors. When I say inquiry with the management, 4 points. 4 points with management, 1 point with internal auditor. 4 points with management are with respect to assessment, their identification of the process. Okay, if they actually, how do they assess the fraud? Okay, we need to understand the process. 2 points with respect to communication, whether they have communicated to TCWG about their processes, whether they have communicated to the employees regarding the code of conduct, the policy, the culture of honesty, etc. And I can also inquire with the internal audit function if they have knowledge about any fraud or suspected fraud, etc. Second, I can talk to the TCWG also. 2 things I am going to ask TCWG: whether TCWG, do you keep an eye, whether you exercise oversight on the management's process with respect to identification and assessment of fraud? And secondly, have you come across any instance, do you have any knowledge about a fraud or suspected fraud? Done. Third point, analytical procedure. I do it, I find fluctuations, I determine that this ROMS is high. Now I need to evaluate whether this ROMS is because of fraud. Now if there are a lot of fluctuations in the revenue items, okay, so this might indicate that this ROMS is because of fraud. Fourth point, other information. If I obtain some other information, let's say industry standards, industry regulatory information, if there is a, let's say some FIR was done against the company with respect to some fraud, okay, all these things will basically tell me that, yeah, they will help me in determining ROMS due to fraud. And last is fraud risk factors. Okay, now having identified and assessed ROMS, you need to remember that 315 tells that ROMS needs to be determined at 2 levels. So auditor will determine ROMS due to fraud also for two levels. One is the financial statement level and the other one is the assertion level. After having identified and assessed the ROMS, the auditor needs to assess, basically to respond to those risks. How is he going to respond? He is going to design overall procedures for ROMS due to fraud at financial statement level. He is going to design further procedures, audit procedures for ROMS at the assertion level. Then third, when there is a case of management overriding the controls, okay, he needs to assess the ROMS due to fraud. And obviously because fraud is involved here, management has, let's say, overridden the controls, this will be basically a significant risk, and auditor needs to assess whether they need to apply extra procedures here. Okay, and last is what? Auditor willing to not able to continue, auditor wants to withdraw. So if, let's say, the auditor finds a fraud, he needs to first check his reporting responsibilities, okay, and then if law permits, he may also withdraw from the engagement. But when he withdraws, if he thinks about withdrawing, he is first going to communicate with the TCWG and the management regarding the same. And let's say he needs to comply again with the regulatory requirements if he resigns. So in India, let's say he needs to file ADT 3 and state the reasons for withdrawing from the engagement. Okay, so 240 done. Any doubts you have? Any doubts? No? Fine. Yeah, we are going to start with essay 250. Now coming back to 200 series. Okay, the name of the standard is Consideration of Laws and Regulations in the Audit of Financial Statements. Consideration of laws and regulations while we are auditing a financial statement. Okay, so now again, before I start the standard, why are you supposed to study this standard? What is the objective of this standard? Let us understand that first. Okay, now you all know, I just want to ask you rather from you that the compliance of various laws and regulations in an entity, is it the responsibility of the auditor or the management? Complying with all the laws and regulations applicable to the entity, is it the duty or responsibility of the management or the auditor? What do you think?
obviously, so to comply with all the requirements of, let's say, of all the applicable rules and regulations, it is of the management. The auditor has got no duty to basically ensure compliance. Okay, so it is the management who is responsible to ensure compliance with all the laws and regulations applicable to the entity. Okay, now as auditors, we are going to be concerned here about the laws and regulations in the audit of financial statement. So why do we need to consider the laws and regulations in the audit of financial statement? Now let me just tell you few things. Okay, now when in this particular chapter, when we'll be discussing about the laws, okay, I'm just giving you a brief idea that we are going to be discussing about two kinds of laws. Okay, one, let's say, which has a direct effect, a particular law which has a direct effect on financial statements. Okay, or let's say some other laws, or let's say others, okay, which do not have, let's say, direct impact on the financial statements. Okay, so I'm dividing law for the purpose of this standard into two categories: one which directly affects the financial statement, and the other which doesn't affect the financial statements as such directly. Okay, now what are let's understand first these two types of laws. Okay, and accordingly we'll be able to proceed with the standard. Okay, now there are certain laws which directly impact the financial statements. Now, for example, do you think income tax act, okay, it is a law, all right? So do you think will it be having a direct impact on the financial statements? What do you think about it? Will this particular law have any direct impact on the financial statements? Yes or no? Yes. In what form? Don't we make provisions for taxation? All the provisions and all that we make, obviously we need to have the knowledge of the Income Tax Act, the management, and accordingly the rates of taxes and all, and accordingly they make the provision, right? So this is a particular law. Income tax is a law which has got direct impact on the financial statement. Now let us talk about the similarly GST laws. Okay, all the GST laws, will it have direct impact on the financial statements? Yes or no? When we purchase or when we are making a sale, yes, it is going to have direct impact. Okay, or let's take the example of, let's say we have employees and we have paid them bonus. So payment of bonus act, let's say bonus act. Okay, let's say PF act. Okay, so all these laws are the laws wherein the financial statements are affected directly. Okay, but there are some other laws also, okay, which do not impact the financial statements, which do not affect the financial statement directly. Let's say the laws which are essential for the operations of the business. Okay, if you want to do this particular business, you have to obtain a license. Okay, so let's say license. Okay, I can say operating laws for the operation, let's say, or I can say environmental laws with respect to pollution. Okay. You are not supposed to pollute, or you are eligible to only emit this much amount of whatever you say, we have carbon credits, etc. So there are many other laws which will not have a direct impact on the financial statements, but which are essential, let's say, for the operation of the organization, which are essential to, let's say, conduct the business. I can do this business only if I get the license, so I need to comply with that law for obtaining the license to conduct the business, right? So there are many other laws which will not have an impact on the financial statements directly. Okay, now why have I divided the laws into two parts? Please understand now that these laws, for these laws, for the ones which have direct impact on the financial statements, the auditor is going to obtain sufficient and appropriate audit evidence, whether whatever figures they have written, let's say provisions they have made, is it correct or not? Okay, so the laws which directly affect the financial statements, the auditor is going to obtain sufficient and appropriate audit evidence for those laws. Okay, but there are certain other laws which never, it is not going to impact the financial statements. Let's say there is some law with respect to the Factories Act. We have 200 plus employees, so they have to maintain a canteen, let's say. So this is a law, the compliance of which has to be done. Okay, but it is not going to impact the financial statements directly. Let's talk about labor law. Let's say some labor laws probably. Okay, now labor laws probably, let's say you have kept child labor. Now probably child labor will be violative of some of the acts in India, but probably it is not going to impact your financial statements. Let's say you employed child labor, children below the age of 14, you paid them wages, no problem about it, but again it is a violation of law, right? So for those kind of laws which do not impact the financial statements directly, okay, an auditor will not be worried about gathering sufficient and appropriate audit evidence, because as such the item is not reflecting in the financial statements, but he needs to ensure whether compliance of the same has been done with. Why? I'll just discuss this. He needs to check the compliance with the laws. Why? Because if I tell you in this way, because it might have something we call as material. It might have a material effect on the financials. It is not going to impact directly on the financial statements. It is not going to impact directly on the financial statements, but the non-compliance of which, okay, he needs to check the compliance, or let's say non-compliance of which can have material effect. Okay. Now, what do you mean by material effect? Now, please understand. Let's say if environmental laws were violated, or let's say the company engaged child labor, okay, and the concerned authority, they came to know about it, and a heavy penalty of, let's say, 5 lakhs was imposed on the company. Now, when the company pays this penalty, the penalty is ultimately going to come in the financials, yes or no? So the non-compliance of which will have a material impact on the financial statements, okay? So maybe the material effect can be in the form of, let's say, penalty, the compensations we need to give. Let's say the organization has failed to comply. Let's say it is a banking company, okay, and banks are required to keep a minimum capital, let's say, to do the banking business. Now the capital comes below the statutory limit. Now probably the license will be their license will be cancelled, or maybe they will not be allowed to continue the business. So going concern will be in danger, right? So something like, let's say, penalty, or let's say going concern can also be impacted, right, because of any violation of the law. So understand my point. What I'm trying to say is, for the laws which have direct impact, the auditor is going to ensure he is going to obtain sufficient and appropriate audit evidence just to see that whatever figures are written in the financials with respect to these laws, whether they are true and fair or not, okay. But with respect to other laws, the impact of which is not directly shown in the financial statements, the auditor will still be concerned whether those laws have been complied with or not, because the non-compliance of which can have material effect on the financial statements, maybe in the form of penalty, maybe, let's say, the company is no longer allowed to do business because the license has been cancelled, and the going concern assumption, the going concern thing will come into the question, okay. So there are two kinds of laws, and for each of these laws, what is the responsibility of the auditor? We are going to cover that, okay. Again, it is a very, very simple standard. Don't go by the number of pages that we have, but let us start this, okay. So I'll come to this theory part also, but okay, I told you this, that who is responsible for the compliance of all the laws and responsibilities. You have to remember, it is not the auditor, it is the management of the company, okay. So please understand this. It is management's responsibility to ensure that entities' operations are conducted in accordance with the provisions of law and regulation, okay. So it is not the duty of the auditor. Compliance with all the laws and regulations applicable to the entity is the responsibility of the management. Done, okay. I'll come to this part. This is an important question. I'll come to this part later, but now let me tell you the responsibilities of auditor first, okay. And under this chapter, under this standard, the responsibilities, again, it has been divided as per the categories of law. That is why I discuss you the two categories of law, discuss with you, okay. So the first one is laws and regulations that have a direct effect on the financial statements. Now if you want, you can write the examples here also, like I told you, Income Tax Act, the CGST Act, let's say, or it can be Payment of Bonus Act 1965, or Provident Fund Act, whatever it is, the ones which have direct impact on the financial statements. Now, category of law. Now, what is the auditor's responsibility if for such categories of law? His responsibility is to obtain sufficient appropriate audit evidence about compliance with the provisions of these laws and regulations. So he will be obtaining, I have already mentioned, he will be obtaining sufficient and appropriate audit evidence for those laws which has got direct effect on the financial statement, okay. Now let us consider other laws here. What are the other laws? Other laws and regulations that do not have a direct effect on the financial statements, but the compliance of which is fundamental to the operating aspects of the business. I told you, for example, a bank, if the minimum statutory, let's say, needs to have a minimum capital requirement, if it falls below, the capital falls below the limit, probably the license will be cancelled, okay. So When we talk about other laws, what is the responsibility of the auditor? He needs to undertake specified audit procedures. He needs to apply some procedures to help identify non-compliance, okay, with those laws and regulations that may have material effect on the financial statements. Okay, if you want to copy this, I just better to write this thing here, that the auditor will be concerned with only the non-compliance if it is the non-compliance of which can have material effect on financial statements. And just for the sake of example, I have given you what can be the material effect on the financial statement. It can be in the form of penalty, or it can be in the let's say the closure of the entire business also, because now let's say their license to operate has been cancelled. So again, material effect on financial statements, whether a non-compliance is causing material effect on the financial statements or not, again it is a matter of professional judgment. Okay, so let me read the point again so that you understand the responsibilities of the auditors in both the scenarios. Okay, I hope the laws which has got direct effect, you need to obtain sufficient and appropriate audit evidence, like you have been doing in all the other chapters, and after you apply procedures you obtain evidence, right? But in case of the other laws which doesn't have a direct effect on the financial statements, the auditor is going to identify non-compliance with other laws, and that may have a material effect on the financial statements. So again, whether it is going to have a material effect on the financial statements or not, again it is a matter of professional judgment. So I hope you are clear with respect to the responsibilities of auditor. Now let us understand, what is the auditor going to do actually? What procedures will he be applying to ensure the compliance with laws and regulations? We are covering both the laws here, okay, both the categories of law. Okay, so the first point, now please understand, you are an auditor. Now be very practical. You go to an entity first in order to ensure whether they are complying with the applicable necessary laws and regulations or not. You need to know the industry. You need to know your client. Okay, you need to know to which particular industry my client belongs, because most of the laws are industry specific also. Now if a client is into service sector, you'll not look for the let's say compliance with the factories act there, right? So the first point, you as an auditor, which you should be considering in this standard, is basically duty to understand the entity's environment. Okay, now can anyone tell me the name of the standard wherein we understand the entity and its environment? Can anyone quote the name of the standard, number of the standard, wherein we try to gain an understanding of the entity and its environment? If you or in short, if I can say, wherein we try to gain an understanding of, or let's say knowledge of the client's business. Name of the standard, if you remember, SA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment, including internal controls. Okay, so 315 we covered ROMMS, we covered internal controls, the entire chapter number 4. Okay, anyways, so the point here is duty to understand the entity's environment and to obtain general understanding about the legal and the regulatory framework applicable to the entity. Understand the entity, then determine, okay, these are the laws that are applicable to this entity or the industry or the sector in which the entity operates, and how the entity is complying with that framework. So determine what laws are applicable to the entity, and having determined this, try and gain an understanding, okay, of how the company is complying with the laws. First point. So we need to understand the entity and its environment here. Okay. Now second, it says duty to obtain sufficient and appropriate audit evidence. Now you will be able to answer this. For which particular law this paragraph must be? For which category of law? Category 1 or 2? It says duty to obtain sufficient and appropriate audit evidence. For which category of law should the auditor? First category, yeah. So the category of laws which has got direct effect on the financial statements, for those laws the auditor will be obtaining sufficient and appropriate audit evidence. And how does he obtain evidence? You all know he applies procedures and he obtains evidence, right? So the auditor shall obtain sufficient and appropriate audit evidence regarding compliance to the provisions of those laws generally recognized to have direct effect on the determination of material amounts and disclosures in the financial statement. So those laws which has an impact on the amount as well as disclosure in the financial statement. So for example, income tax provisions, GST, bonus, etc. So how will he be obtaining sufficient and appropriate audit evidence? He may himself, let's say, do a re-performance or not, recalculation. He may himself calculate the provision that has been made by the company, let's say provision for taxation. right? So there are procedures. So just remember that he needs to apply procedures and obtain sufficient and appropriate audit evidence for all those laws which has got direct impact or direct effect on the financial statement. Okay, all right. Now second, it says duty to perform procedures. Now the auditor has to perform some specified audit procedures. Okay, the auditor shall perform the following audit procedure to identify instances of non-compliance with other laws and regulations that may have a material impact on the financial statement. So he is going to perform some, this is what we call as this is specified audit procedure. If it's okay even if you don't write. Okay, the auditor shall perform the following procedures to help identify instances of non-compliance. So please understand, this is for other laws. For other laws, we are always concerned about what? Non-compliance. Why? Because the non-compliance of these other laws, it may have material effect on the financial statements. So how am I going to know whether the company has complied with other laws or not, or whether it has violated other laws? So first thing which I'll be doing is inquiry of the management. Okay, so inquiring of the management and wherever appropriate TCWG as to the whether entity is in compliance with such laws and regulations, whether the entity under consideration has complied with all the laws and regulations, and inspecting correspondence, if any, with the relevant licensing or regulatory authorities. Now what is going to happen, please, again, let's say I'm doing the audit. Okay, now if the company, let's say they have violated their licensing rules or regulations with respect to the licensing requirements, let's say they have violated the environmental laws, so whatever it is, so the concerned department is going to send a wonderful letter to the organization. They'll write that you have violated this and this section. Probably there will be some amount of penalty, or it can be in a form of a show cause notice also. So if the auditor comes across such correspondences from the departments, he'll get to know, obviously he'll get to know that yes, they have received that letter because they must have violated some provisions, right? So there are two procedures which I should be seeing. Okay, it says the auditor shall perform following audit procedure to help in identify instances of non-compliance with other procedures. What are the procedures? He shall be inquiring of the management and TCWG. Secondly, he might inspect. See the word inspect. Inspect means when I told you this, when you check on a document. Okay, it is called inspection. So inspecting the correspondence from whom? From the relevant or licensing or regulatory authority. In fact, other procedures. If I wish to tell you if you want to know the other procedures, you can even refer to if you remember, you covered something in 501. As far as litigations and claims were concerned, you can go through the minutes of the board meetings, because if there is a non-compliance, they must have discussed about this matter also. So you can refer to the minutes of the board meetings also. Okay, so these are some procedures which the auditor needs to perform in case of other laws. Okay, just remember the word in case of other laws. The key word is we are going to check on the non-compliance. Okay, all right. Then we have fourth point. See, whatever law it be, okay, he has the duty, the auditor has to remain alert throughout the audit for instances of non-compliance. Okay, so the auditor shall remain alert to the possibility that other audit procedures applied. Now, other audit procedures applied may bring instances of non-compliances. He should be alert throughout the audit. Maybe he inquired, he did an inquiry with the management, or let's say he has not. Basically they have not received any correspondence and all, but maybe when he is doing some other audit procedures, please understand this, maybe when he is doing some other audit procedures, they may basically let's say other audit procedure, as in he reads the board meetings and all, he may come across instances of non-compliance. So the point simply says that the auditor should remain alert throughout the audit. Okay, so the auditor shall remain alert to the possibility that other audit procedures applied by him may bring instances of non-compliance. Let's say he visits factory for some reasons. Okay, and all of a sudden he sees a lot of children working there. So his intention was to do some different procedures and get some other evidence, let's say, but he sees a lot of children working there. So we are doing some other audit procedure, but we come across instances, so we should always be alert. Okay, yes, this is violation of, let's say, some labor laws in India, right? They have engaged child labor here. Okay, so what I'm trying to tell you is under point number 4, it is your duty as an auditor to remain alert throughout the audit. It may so happen that you do some other procedures, but it may uncover, let's say, instances of non-compliance. Okay, all right. And Finally, fifth point, duty to obtain representations by management. This is nothing but written representations. The auditor shall request management and where appropriate TCWG to provide written representations that all known instances of non-compliances or suspected non-compliances with laws and regulations whose effect should be considered when preparing financial statements have been disclosed to the auditor. So this is also one of the considerations the auditor needs to he needs to obtain the written representations from the management that they have disclosed to him. They have disclosed all the instances of non-compliances or suspected non-compliances of those laws and regulations which might have an impact on the financial statements. Okay, so which should be considered when preparing financial statements as has been disclosed by the auditor. Okay, now again, I hope this is clear to you. So these are this can be asked in the exam. What are the audit procedures with respect to the consideration of laws and regulations while auditing the financial statement? So first point, and in fact I feel, what, after point number 5, after point number 1, the point which should come actually, if I go by sequence, if I tell you practically, is point number 5. Okay, so first I need to obtain an understanding from the understanding about the entity, about the applicable laws, about how they comply with the laws, all this. And secondly, before I start with my procedures, I should obtain a WR from the management, wherein I would ask them to give me in writing regarding all the cases of non-compliance with laws. Okay. Thirdly, now third point is I'll try and obtain sufficient and appropriate audit evidence for those laws which has got a direct effect on the financial statement. Fourth, I'll perform some specified audit procedures in order to obtain evidence with regard to non-compliance of other laws. Other laws means the ones which do not have impact on the direct effect on the financial statements, but which may, please emphasize the word may, but which may have, what is the word, material effect on the financial statement. And what can be the material effect? I already told you. It can be in the form of penalty. It can be in the form of, let's say, company shutting down. Let's say it can be in the form of cancellation of license, and all this will have an impact on the financial statement. Now, if you are on the verge of shutting down because of a violation of law, don't you think this point should be there in our financials and audit report? Yes, because going concern is no longer appropriate. Now the management should bring this aspect in the financial statement and the auditor should report it. Okay. Now let's say this is the company did not comply with some licensing requirements and the license has been cancelled. They are not into production now, let's say. And I'm just, we have just started with the audit and I get to know about this. Okay, now please understand this. As I'll request management that yes, this is an important thing because you have violated, let's say, and there are laws that for 1 year, for next 1 year, you cannot reapply for the license. Let's say this is a kind of law. So obviously for next 1 year, they'll not be able to operate only. So obviously the management needs to, I'll request the management to consider this aspect, to basically make note of this aspect, or let's say to revise the financial statements and incorporate this aspect. Okay, now if they don't do it, probably I'll have to modify my opinion. Getting my point? So please understand, when I talk about other laws, okay, other laws may not have a direct impact or effect on the financial statements, but it may have a material impact on the material effect on the financial statements. You have to understand this, okay? And fourth point is what? Finally, throughout the audit, the auditor needs to be very alert. He needs to be cautious when doing other audit procedures, because other audit procedures might uncover certain instances of non-compliances. Okay, are you all clear with this part? And probably this might be the question which is generally asked in the exam. All right, is it clear to everyone? Yes? All right. Okay. Now, the second part. What if, let's say, you get you come across an instance of non-compliance. Okay. You either identify non-compliance or you have doubts on it. You suspect a non-compliance. Then what has to be done? Okay. You come across an instance of non-compliance, or you have a doubt that there is some non-compliance with respect to this law. So what do you do about this now? Okay. So let's understand. If the auditor becomes aware of information concerning an instance of non-compliance or suspected non-compliance with the laws and regulations, the auditor shall first obtain an understanding of the nature of the act and the circumstances in which it has occurred. So first I need to know, we need to understand, okay, this is the act under which the non-compliance has been done. Okay, so I need to understand the act, I need to understand the circumstances. Okay, and further information to evaluate the possible effect on financial statement, and I need to consider the further effects. Okay, now the company has violated environmental laws, and this is the letter they have received from the department, probably they'll have to pay the fine. So okay, adequate provision must be made now. So adequate, I'll ask the company to revise the financials, right? So this is why we need to consider the applicability of laws and regulations. So two things. In first point, I'm covering two things. If the auditor becomes aware of circumstances which basically indicate non-compliance or suspected non-compliance, okay, or the auditor suspecting non-compliance, then what shall he be doing? He shall first try to understand the nature of the act. Okay, what went wrong? What happened? Okay, what was the circumstance? And secondly, okay, if this has happened, now what is going to be the effect of the non-compliance on the financial statement? This is the second aspect he needs to be concerned about. Okay, all right. Now, if the auditor suspects that there may be non-compliance, okay, the auditor shall discuss the matter with the management and TCWG. Obviously, any case where you find non-compliance or where you have a doubt regarding any non-compliance, discuss the matter with TCWG and the management. Okay. Now, if the management or TCWG do not provide sufficient information that supports their entities in compliance with the laws and regulations, let's say they do not respond to us well, they do not give us adequate information to prove that they have complied with the laws and regulations, then what can be done? Then, in the auditor's judgment, if the effect of the suspected non-compliance may be material to the financial statements, the auditor shall consider the need to obtain legal advice. Now, if I have a doubt on doubt on particular, let's say, non-compliance, okay, of a law, so I'll discuss the matter with whom? TCWG and the management. Okay, and obviously when I discuss, what am I going to expect? I would be expecting that they are going to reply to me, they are going to engage in a healthy discussion, okay. But let's say they do not give me adequate evidences, they do not give me, they do not participate in the discussions, and as a result of which I don't get, let's say, sufficient evidence of them, let's say, complying with the laws, okay. So in this case, what should be done? I am still in a doubt, right? So I should obtain legal advice. Now, who can you obtain the legal advice from? Either it can be the in-house legal counsel, if you remember this word again, 501 we covered, or it can be the external legal counsel of the company, external legal counsel, okay. You can write it also if you want, external legal counsel. Okay, but it might also so happen, I'm just going a bit further into the discussion. If you remember connecting with 501, if sometimes it so happens, if I ask an external legal counsel something about the client, okay, they may not want to tell us everything, because they themselves are bound by code of ethics, by the clause of by the let's say confidentiality principle. So they might not want us to tell everything, because we are just a third party for them, for the external legal counsel. So in this case, if still you are not able to find out basically whether there was a violation of law or not, so that is why you're taking the help of the experts here. But these experts are working for the company. One is a internal expert, internal in-house legal counsel, and the other one is external legal counsel. If you are not able to get information from them also, probably you need to engage your own legal advice. You need to consult your own legal counsel. You need to basically go to your own, let's say, advisor, friend, or lawyer, whosoever is he. Okay, so this is a third point. What all we have covered here. If you come across any instance of non-compliance or you have doubt, so the first thing you need to do is understand the nature of the act and the circumstances in which it has occurred, and you need to consider the impact, whether it is going to have effect on the financial statements. Second, if there is non-compliance or you suspect, maybe you should discuss with the management and TCWG. Obviously you are going to expect them to reply to you, come up with adequate proof that they have complied with the laws and regulations. But let's say if they don't do it, you need to now obtain legal advice. Legal advice from whom? Maybe the internal legal counsel or the external legal counsel of the entity. If they also don't provide you, if you fail to obtain, let's say, required information from them also, probably you might need to consult your own legal expert. All right. Now after this, if sufficient information about suspected non-compliance cannot be obtained, if you have doubts, if you are not able to obtain sufficient information about suspected non-compliance, the auditor shall evaluate the effect of lack of sufficient appropriate audit evidence on the audit report. So probably if he is not able to gain, then he might basically disclaim, or let's say might come up with a qualified opinion as well. He might have to consider the impact on the audit report. Okay, so these are procedures when non-compliance is identified or suspected. Now very, very simple. All right. Then last part of the chapter, last part of the standard, then this deals with reporting of identified or suspected non-compliance. How shall we be reporting? Okay. Now I told you that whenever the auditor identifies a non-compliance or he suspects a non-compliance, okay, we just discussed that he needs to discuss the same with TCWG or the management. Okay. So first thing is reporting non-compliance to those charged with governance. As soon as we find any non-compliance, we are going to report it to the TCWG. So it says unless all of those charged with governance are involved in management of the entity, the auditor shall communicate with TCWG matters involving non-compliance with laws and regulations that come into auditor's attention. So now let's say if management is only the TCWG, in small companies this happens, the TCWG and the management is same. Okay, so if TCWG and management is same, obviously management must be knowing that yeah, these are the laws that they have not complied with. Okay, so the point here says unless all those charged with governance are involved in management of the entity, the auditor shall communicate with TCWG about matters involving non-compliance with laws and regulations. Okay, now if second point, if in the auditor's judgment the non-compliance is believed to be intentional and material, okay, the auditor shall communicate the matter to TCWG as soon as practical. So if it, and on top of it, if let's say the auditor finds that no, this has been done intentionally, there might be some chance of fraud, and also he is going to immediately communicate to TCWG. Okay, now the next point is, let's say now if auditor suspects that the TCWG themselves are involved in the non-compliance, okay, if management and TCWG both are involved in non-compliance, then what is going to happen? If the auditor suspects that the management or TCWG are involved in non-compliance, the auditor shall communicate the matter to next higher level of authority at the entity if they exist, okay, such as an audit committee or a supervisory board. So audit committee is relatively independent. If you remember, I told you its composition, that majority of the directors, let's say, needs to be independent directors there. Okay, so if let's say TCWG, you have a feeling that the non-compliance, TCWG is also involved in the non-compliance of the laws, then you can report to the audit committee. And where no higher committee, let's say, authority exists, or if the auditor believes that the communication may not be acted upon or is unsure as to whom to report, the auditor shall again need to obtain legal advice. He shall need to talk to his own lawyer or advocate, because they are the ones who are expert in laws. As an auditor, we are not expert in all different laws. We are only expert in auditing and accounting, right? So when violation of other laws happens, what has to be done, what not, what can be the consequences, and if the consequences will have an effect on the financials or not, all these things we might have to discuss with the external legal advisor. Okay, so we can approach him. Right now, this was what we have covered here, that in case of non-compliances, the auditor is going to report to TCWG. Now please understand, he is going to report to TCWG unless TCWG and management is same. Secondly, if there is, let's say, he finds that the TCWG themselves are involved, probably he is going to report it to one higher authority, next higher authority, let's say audit committee. Now if an committee is like an audit committee is not there in a organization, the next higher authority is not present in an organization, then the auditor probably will have to think that whom should he be reporting, whom should he be consulting. So he may seek to obtain legal advice there. Okay, now coming to the report part, again, reporting, we have, okay, as an auditor, when instances of non-compliance is found, we are going to report to the governance, no doubt about it. But at the same time, obviously, you need to report it in your auditor's report also. Report non-compliance in the auditor's report. Okay, so now in case of, now please understand, let's say I'm just asking you, there are two laws like category 1 and category 2. All right, now let's say there is non-compliance. I'm just asking you very simple, there is non-compliance of category 1. Will the impact come in our audit report? Yes or no? If there is non-compliance of category 1 law, will the impact come on our audit report? Let's say the provisions the management has made, they have not complied with the law. They have calculated wrong taxation rates, and they are now not changing, they are not revising their financial statement. So in this case now, will you need to modify or qualify your financials, yes or no? Yes, okay. But in category 2, let's say other laws, they have engaged child labor. Will you need to modify or give an adverse opinion now? No. But let's say they have engaged child labor. The department has comes to know about it. You have received a letter from the department of 5 lakhs. We ask the management to change the financials and make a provision of 5 lakhs. Let's say they are not doing now. Should I give a qualified opinion now? Yes or no? Yes. So what I'm trying to tell you here is, as far as other laws is concerned, the impact of this non-violation, or let's say non-compliance of other laws, is going to come in the audit report only if the auditor feels that the non-compliance has got, the word you have to remember here is material effect on financial statements. If the non-compliance of other laws has got material effect on the financial statements, then obviously the auditor is going to maybe is going to modify or change his opinion, whatever it can be. All right. So the point here is, if the auditor concludes that the non-compliance has a material effect on the financial statements and has not been adequately reflected in the financial statements, I asked the management to make provisions. They did not make it. So in this case, what am I going to do? Sorry. I'm either going to issue a qualified opinion or an adverse opinion. All right. Now, if the auditor is precluded by management or TCWG from obtaining sufficient appropriate audit evidence, all right. Now, when do we try and obtain sufficient and appropriate audit evidence for which laws, which category? 1. Okay. So if the management precludes us from obtaining any kind of evidence, so what are we going to do here? We are going to either give a qualified or disclaim an opinion. Okay. And finally, if the auditor is unable to determine whether non-compliance is occurred because of limitations imposed or by the restrictions rather than by management or TCWG, the auditor shall evaluate the effect, not required as such. Okay. You just covered these 2 points. So please understand, if it has got material effect on the financial statements and it has not been adequately reflected in the financial statements, either qualify or adverse, you are not able to obtain evidence. Okay. Sufficient and appropriate audit evidence regarding, obviously, which kind of category of law will it be? 1. So you are going to give qualified or disclaim an opinion. Okay, not very important, but okay, just for your reading you need to know. Alright, so with this, the standard is complete, but we have 2 more questions to cover. Okay, now I told you this, that see, this is an important thing, you need to cover this part. Okay, then we covered that audit procedures where non-compliance is identified or suspected, and the first point goes by this line: if the auditor becomes aware of information concerning an instance of non-compliance. Okay, so how will the auditor come to know about a non-compliance? What can be the possible indicators of non-compliance? This is what we have to cover here. Okay, this can be an important question. I have given it here. Okay, see, the heading is indicators of non-compliance. Or it can be asked in the form of a question also. With reference to essay 250, give some examples or matters indicating to the auditor about non-compliance of laws and regulations. What will those factors be? What will be those events and conditions? If you remember the word events and conditions, okay, in going concern we covered this. So what can be those matters, or okay, which gives us a hint that okay, there might be non-compliance. Okay, please understand here we are using the word indicators here also. These are indicators of non-compliance. If you remember, we covered something called as indicators of in case of going concern. If you remember, okay, we covered 3 areas. Do you remember? Indicators that going concern assumption is not valid, not appropriate. What are the indicators? If you remember, we covered the financial part, operational, and others. We covered this in essay. Yes, indicators when going concern is not appropriate. So financial indicators were there, operational indicators were there, and others. Okay, if you remember operation, I told you, or let's say financial, I told you that the company has got net liability position. Okay, cash flow is negative, profits is going down. When it comes to operation, let's say the suppliers have stopped giving us raw material on credit, the CFO, the top management is leaving and nobody is willing to join. All these points we discussed, right? Similarly, we have to discuss some indicators which may give an idea, okay, there might be non-compliance in the organization. So what can be the indicators? Let us understand now. Very simple indicator is, all of a sudden, let's say you are doing an audit, the next day you go and then you find that there are 20 officers sitting and there is a raid going, or let's say there is an investigation going under some different law. Okay, so an investigation probably might give you a hint. Okay, they must have done something wrong. They must have not complied with the provisions. Hence, the authorities are here to investigate. So, one point is what? Investigations. Okay, or you come across, let's say you are going through the bank statement and all of a sudden you see 5 lakh payment has been made. So you'll ask, what is this payment all about? They'll say that we paid to this department. You'll ask why. So probably they might try and hide things, but when you question them further, probably they'll tell you that okay, this was a penalty that that we have paid for it, but yes, we somehow were not aware, or it was a non-compliance from our end, whatever it is. So any penalty or fine will give an idea to you that yes, there has been a non-compliance. Okay, all right. So this is one point. Let's go through some of the points. Adverse media comment. All of a sudden, your name of the company is in the news. People are giving adverse remarks regarding your company, maybe because you violated some law. Now all this, if you harm animals, let's say during your work, if you engage child labor, all this human rights people and the PETA and all the animal right and all, they'll come obviously, and there will be adverse basically media comments. Okay, then a few more points. Let's say yes, unusual payments towards legal and retainership fees. You go through the ledgers, so you see that oh, this particular year a lot of fees has been paid to a lawyer or an advocate. Why? So we are going to ask them why. So probably then we see, if we find out that okay, there is this case going in High Court against the company for non-compliance of some other laws. Okay, so that is why they have been paying their professional charges to the advocates. Okay, so unusual payments towards legal and retainership fees. All right, then what can be the other points? Let's say unusual transactions with companies registered in tax havens. So you do an unusual transaction with companies registered in tax havens. Tax havens means the countries where there is no any tax structure as such, like Mauritius, Cayman Islands. Okay, so we have done transactions there. So this might indicate that probably you must have tried to convert some of your unaccounted cash into, you have done a transaction, you want to just reroute the entire money and bring it back to the economy. Maybe this is money laundering case, maybe. All right, so these are indicators. I'm not saying that yes, this is a case of non-compliance, but if these examples happen, these are the case of basically what, indicators. All right, now let's go through few more points. All right, yeah, payments for unspecified services or loans to consultants, related parties, employees or government employees. You have paid money for unspecified services, like you have made the entries of payment but the services are not specified, and the payments are either made to related parties, maybe your employees, maybe government employees, in the form of, let's say, bribe, corruption, etc. Okay, related parties. This morning only, when I was discussing SA 550 with you, I told you that related parties is an area where the RMS is very high. If I want to indulge in a fraud, I want to, let's say, inflate my expenses in order to curtail my tax liability, probably I'll go and talk to my relative. I'll ask him, I'll tell him, I'll give you a 5 lakh check, you just give me back in cash. So in that way, what is going to happen? I'm going to increase my expenses and my tax liability is going to be less. Okay, so this is one point. Let's say yeah, unusual payments in cash. If you make huge payments in cash, again, then there's a problem. Okay, then purchasing at prices significantly above or below the market prices. You either purchase it at a very high price. Now why will you be doing that? Why will you be doing that? Again, to inflate your expenses, let's say. Okay, or let's say you purchase it at a very low price. Maybe this year you want to show some sales. Maybe there is a requirement that okay, if your turnover, if you earn this much of profit, then you'll get the tender. So you are trying to basically reduce the amount of sales. All this may lead to these are examples which basically show that yeah, there might be non-compliances in the organization. So just go through them and please mark it as important also. Okay, just go through them. All right, and yes, no, please repeat your question. You are saying if the non-compliance of other laws is not going to materially affect the financial statements, then we don't have to do anything. Then yes, see, we are auditor. The name of the standard is what? Consideration of laws and regulations in audit of financial statements. If it affects the financial statements, and how will it affect also, I told you. How will it affect? In the form of, let's say, penalty, in the form of, let's say, I told you, if we violate any licensing requirements, okay, the provisions with respect to the licensing requirements, and if they cancel our license, obviously our going concern itself will come under question, right? So all this non-compliance will have material effect on the financial statements, but probably all non-compliance, let's say, might not have. So that is why I was emphasizing on the word may. he needs to identify non-compliance with those laws and regulations that may, it clearly says, that may have a material effect on the financial statements. Are you clear on this now? Yes, yes, exactly. All right. Now, I told you this, that there's one more question. Again, it is a theoretical question, but it may be asked at the C Enter level. Okay. What is this question? I told you that before we started with the center, with this standard, that it is the responsibility of the management to comply with the laws and regulations, right? Okay. And how shall the management be complying with the laws and regulations? So we have a point here. It says the following are the procedures an entity may implement to assist in the prevention and detection of non-compliance with laws and regulations. Basically, we are discussing on the controls. What controls should be in place? What controls needs to be designed, implemented by the management to ensure prevention as well as detection of non-compliance of laws? They would never want an organization, or the management would never want basically to go for to do a non-compliance, basically not basically to violate a law. They need to have some controls in place which is going to help them to prevent non-compliance, as well as, let's say, if they happen, detect the non-compliance. Okay, so what can be the control? So let's understand now points. Okay, first point is, see, in the management first should be knowing that, okay, what are the laws applicable to them, then only they can think of complying with them, right? So monitoring legal requirements and ensuring operating procedures are designed to meet this requirement. So first thing that the management needs to ensure, we are reading the controls. Okay, so the first thing which the management needs to ensure is they need to know their legal requirements. Okay, and yeah, as per these legal requirements, just a moment. Yeah, okay. So as per these legal requirements, an internal control system must be established. Instituting and operating appropriate system of internal controls. They must have a proper system of internal control. So they need to know their laws applicable on them, and accordingly they need to implement controls. Okay. Apart from these 2 points, I'll just try and write some sequence. Now, the employee should also know that, okay, these are the laws that need to be complied with. Okay, this return has to be filed on a timely basis. The factories, let's say the workers working in the factory should be knowing, okay, these are the laws they need to comply with. They need to be updated, right? So the point here is developing, publicizing, and following a code of conduct. So the company needs to make a code of conduct. Code of conduct means what? The policies which all the employees, all the stakeholders need to abide by. Okay, so code of conduct is a control, right? But only by drafting a code of conduct will not ensure compliance. This code of conduct needs to be communicated to everyone, and everyone needs to be trained according to this code of conduct, right? So 3 points here. Code of conduct should be developed. Okay, then again, let me check. Yeah, this point should come first if I go by the sequence. Ensuring employees are properly trained and they understand the code of conduct. So communicate the code of conduct, train the employees to follow the code of conduct. And after giving the training, now you have to check whether the employees are working as per the code of conduct or not. So come to point number 5, monitoring compliance with the code of conduct. Okay, so if I renumber them, this is 3, this is 4, and this should be 5. This is 1 and 2. Are you able to understand? Third, fourth, and fifth, all 3 points with respect to code of conduct. First they develop it, then they communicate and train people accordingly, and then thirdly, and the third point, as in my 5th point, they are going to monitor whether employees are adhering to the code of conduct or not. Okay, 5 points done. 2 more points. Now 6th and 7th, very simple. Engage legal advisors to assist monitoring legal requirements. Now, if let's say you grow, your organization is growing, you have become a big organization now, probably it will not be possible for you to ensure compliance with every law. So that is why big companies, they have a legal department of their own. So you need to hire people who are expert in laws. They are the ones who are going to ensure that yes, all laws and regulations are complied with. Okay. So we have a point, engage legal advisors. This will be your 6th point. And 7, maintain a register of significant laws and regulations with which the entity has to comply. So you can maintain a register of all the laws that are applicable to you, who is in charge of that particular law, who is responsible for ensuring compliance and all. So you can maintain a register. Okay, so these are the points that you need to understand. What is the question that can be asked? They will ask you that it is the responsibility of the management to comply with the laws and regulations. Yes, it is. So what procedures can the management of an entity implement for prevention and detection of non-compliance. So 7 points I think we have, very simple. First is what? Monitor your legal requirements. Okay, what laws are applicable on you, what laws are, let's say, very important to you. Okay, then implement the controls. Third, fourth, fifth, with respect to code of conduct, develop code of conduct, communicate code of conduct, ensure compliance with code of conduct by monitoring. Okay, engage legal advisors if need be. And seventh point, maintain a register of all the laws that are applicable on you, who is in charge of the laws, all these details. Just maintain a register. This is also a part of your control. Okay, so again, at the inter level they may ask you, this is a theoretical question, so they may come up with this question also. So please, overall, in this standard, now if I tell you honestly, 3 questions you have to cover. In all 3 questions, this is first question that you need to study. Okay, this is the second question that they may ask you, that what are the auditor's consideration of compliance with laws and regulations. So all the 5 points you have to write. And the third question that which they may ask you is the list of indicators of non-compliance. Okay, so these are the 3 things that you have to cover in this particular standard. And with this, again, standard 250 is over. Consideration of laws and regulations in the audit of financial statements. Okay. Alright, so we are going to cover one more standard here, a very small standard, essay 299. This is not given in your printed material. Okay, so we are just going to cover it from here. Joint audit of financial statements. Joint audit of financial statements. Okay, now what do you mean by joint audit? Let us first understand this. It says a joint audit is an audit of financial statement of an entity by two or more auditors appointed with the objective of issuing the audit report. So when an audit is conducted for one entity by 2 or more auditors, okay, we call them as joint auditors. All right, now before I move ahead in this particular standard, let's understand what joint auditors mean. Okay, now let's say this is a very big company, X Limited. This is a very big company, and now they know that okay, it will not be possible to basically for one auditor to perform the audit very effectively and efficiently in the given time frame. So, and they have their operations in entire India, let's say. Okay, so they appoint 4 auditors. Let's say A and company, B and company. These are all auditors. C and company, and we have D and company. All right, and when these 4 auditors work and they give an audit report, they'll give one audit report for the entire financial year. Okay, so they will be called as joint auditors. This is a case of joint audit, and each of these auditors will be known as joint auditors. Okay, please be very careful. Now it might also happen that let's say we talk about another case, X Limited. Okay, and in this X Limited, let's say they have certain divisions, so they have certain branches. All right, for the branches they have 2 auditors. Let's say B and company for branch 1, for branch 2 they have C and company. All right, they have a division. Okay, for the division, let's say they have another auditor, D and company. Okay, whatever it is. All right, now please understand, when I say that X Limited, the main auditor is, let's say, M&N company. The main auditor is M&N company, but they have some auditors, some branch auditors, some division auditors, etc. Now this case, this is not a case of SA 299. These are basically, in terms of standards, if I say, they are known as components. Okay, and this M&N company will be known as principal auditor. Okay, so if you know what happens now in case of branch auditors and all, the branch auditors are going to send the report to principal auditor. So the only auditor here is X Limited. This is not a case of joint audit. For this scenario, SA 600 is applicable. SA 600, using the work of another auditor, using the work of component auditors, SA 600 is applicable. But joint auditor means what? This scenario, one company, because it is a big company, audited by different CA firms, and they collectively, let's say, the aim is to issue one audit report. Are you all clear on this? Yes? Okay. Now, having understood this, now let us go back to the notes. It says a joint audit is an audit of financial statements of an entity by 2 or more auditors appointed with the objective of issuing the audit report. So each of the auditors in my example will be called as joint auditors, right? Now why did the concept of joint audit evolve? Okay, now very practically, if you think, obviously it is a very obvious answer. It is going to be that joint audit, the concept of joint audit is more popular in big companies or small companies? Yes, the answer should be what? Obviously the big companies, right? In case of small company, perhaps one single auditor will be able to complete the audit within the given time frame. But in case of large organizations, they have the concept of joint auditors. Okay, so what are the advantages? Why do clients go for joint audits, or what is the advantage that joint audits accrue to the CA firm? So let us understand a pooling and sharing of expertise. Now Reliance company, Reliance Industries, let's say they have joint auditors. Okay, now they know that, okay, if they appoint 2 or 3 auditors, let's say, they are basically pooling and the experts, and obviously they will be sharing of expertise, sharing of knowledge will be there. All right, and this would lead to what? Better quality of work. Then as an auditor, for me also, it is going to cost lower cost to carry out the work. How? Because if let's say I am the auditor and I have to audit all the branches in India, probably I'll have to travel a lot. And when I travel, okay, I'll take the reimbursement from the company itself. For the company also, it is going to be very costly. Rather, what they do, let's say north, east, west, south, they appoint 4 auditors, so that at least they save on their traveling time. And when the audit of north is going, simultaneously the audit of south area is also going, right? So overall cost will go down. Okay, I'm not talking about the fees, but overall cost will go down, right? Okay, and when there are 3 or 4 auditors, okay, there will be healthy competition also. They are going to issue the same audit report. They are going to come up to a unanimous decision in most cases, but each one will work in a better manner, because now they know, okay, if I don't exercise, let's say if I'm little bit of negligent in performing my work, the other auditor will get to know. So when there are 2 or 3 professionals involved, okay, so your quality of work as such, it improves. Okay, it becomes a healthy, there arises a situation of healthy competition. Let's say you find out a misstatements or something, so other will also say, no, I need to work better, I need to find I also shall be finding any, let's say, misstatements if they have. Okay, so all these things leads to better competition also. So these are the advantages. Okay, but there might be some disadvantages also, and this standard has been introduced because of the disadvantages only. Now what will be the disadvantage? There will be coordination problem. There are 4 auditors. One auditor may think that they know better. There might be superiority complex feeling, let's say, among one of the 4 firms. Let's say whatever it is, there might be lack of coordination. So there might be then lack of clear definition of responsibility. They might not be able to decide as to who is going to do what work. So lack of definition of responsibility. And then they start the blame game. No, this was the area that you covered, this is how you told me to do it. All these things will happen, right, when there are a lot of people involved. Then negligence of areas of common concern. Let's say we 4 auditors, A, B, C and D, they decided that this is an important thing, we'll do it together. Now in areas which is common, okay, wherein they have not divided the work, the areas which is common, everyone becomes negligent. They think, okay, let B do it, B will think, hey, C will do it. Okay, these are common areas, because for a common area they are jointly responsible, right? But for the individual, generally what happens, okay, let me put it in this way. Now these are the 4 auditors that have been appointed. Okay, so before they start doing the audit, generally what happens, among these, they will divide the work. There is division of work involved. But though some of the work, which they feel is really very important and all, they may not divide it. So we call it as common work. But in case of division of work, what happens when the work has been properly assigned? Let's say the south area will be covered by A, B will cover the north area, whatever it is, let's say. Okay, or let's say A and company is going to look into the only assets of the financial statement, B will look on the liabilities, C is going to be concerned with expenses. The division can be on any criteria. I'll discuss that. But what I'm trying to tell you here is, when the work is properly divided, when there is division, each firm will do their work in a very professional manner. But when it comes to common area, they know, okay, B is also responsible for the same, C is also responsible. So they might basically show some negligence there. All right, so the point here is, this is also a disadvantage, negligence of areas of common concern. And the most important disadvantage is basically sharing of fees. All right, now if I would have done this audit alone, let's say the fees is the fees is 10 lakhs, okay, for combined all joint auditors together. If you might have this feeling now, probably on the basis of division, I might be getting only 2.5 lakhs if there are 4 auditors. Had I done this audit alone, probably not 10 lakhs, but at least I would have got 7 lakhs or 8 lakhs. Okay, you might have this feeling in your head going on. So sharing of fees is also a disadvantage. Okay, so now because of these advantages, and specifically because of this thing, coordination problem, who is going to be responsible for which part of audit, okay, negligence shouldn't happen in case of common areas. For all this problems or disadvantages, we have the standard SA 299. The name of the standard is again Joint Audit of Financial Statements. Okay, so how the joint auditor should behave, okay, who shall be responsible for what kind of work, and who is going to issue the report, what if there is a difference of opinion amongst the joint auditors, all these things we are going to deal in this standard. Okay, so let us start with the requirements of the standard. Only 3 requirements, only 3 areas we have to cover here. What are the areas? First, audit planning, risk assessment and allocation of work. Audit planning and risk assessment. In any type of audit you do, whether you are the sole auditor or there are the case of joint auditors also, any audit we have to do an audit plan, we have to go with the risk assessment, and then we have a specific point here in case of joint audit, that is allocation of work. Okay, now after doing this, probably you go to the field work, you do the audit. So we are going to discuss about responsibility and coordination of joint auditors. Who will be responsible for which area, how are they going to coordinate among each other, all these things we have to cover here. Okay, and thirdly, how are they going to report, audit conclusion and reporting. So these are the 3 areas which the standard focuses upon. Okay, so let us start with the first area, first requirement, audit planning. 3 words: audit planning, risk assessment and allocation of work. Now please understand, we have covered the concept of audit planning. Now let's say there are 4 auditors involved. Who do you think will be involved in the planning part? What do you think? Common sense. What does your common sense tell you? Who should be involved in planning? Auditor A, B, C or D, or all of them? What do you think? All of them. Okay, and if you remember, before planning something else comes. We covered 3 words if you remember: audit strategy, and according to the strategy the audit planning is done, and then the audit program, right? And when I talk about audit strategy, if you remember, I use the word STD, scope, timing and direction. And if you remember, I told you that once the audit strategy is set, it gives the direction for the preparation of audit plan, right? So I have written here something that we are discussing this part now. Okay, part 1, if you can see 1. Okay, so joint auditors shall jointly establish an overall audit strategy. If you remember, overall audit strategy, we discussed the concept of audit strategy in which SA 300. Okay, and strategy means what? You are the overall, all the joint auditors together, they are jointly going to discuss and establish an overall audit strategy which is going to discuss on the scope, time and direction of the audit. And ultimately, when we have a strategy, it helps us in planning also. It gives us a guidance in audit planning. So who is going to be engaged in audit planning? See what I have written here. The engagement partner. EP means engagement partner plus engagement team. The key members. So engagement partner and engagement team. Of which firm? Of all the firms, of all the joint auditors. So we have 4 firms in my example. So engagement partner from each of the firms and their respective team members are going to jointly make the audit plan. Okay, so first they jointly made the audit strategy, and from the strategy will come the audit plan. So next point, the engagement partner and the engagement team members, obviously the key members from each joint auditors, shall be involved in planning the audit and shall develop a joint audit plan, and they shall come up with a joint audit plan. Are you clear on this, everyone? Yes? Okay, all right. But there can be one important question asked, very important question that can be asked from this part. Okay, let's say they'll give you a point here. Okay, that in case of joint audits, the engagement partner and the key engagement team members from each of the joint audit firm, they make a joint audit plan. What are the consideration? What are the factors to be considered in while making the joint audit plan? Okay, so that is why I've written here points to be considered. This is an important question. While the joint auditors will be making or developing a joint audit plan, what are the factors? What are the points that need to be considered? Okay, very simple again, but let's see. Identify. Okay, when we are developing a joint audit plan, we need to identify the common audit areas and the areas which we have not divided, and the division of audit areas. Now division can be in many ways. I will teach you this later. See, we have some point with respect to division, but yes, we need to incorporate this in our plan. We need to mention this in our plan, that which are the common areas to be audited by all the joint auditors, and how have we divided the work, the division, this particular work will be done by whom. All this needs to be mentioned in the plan. So division of audit areas. Okay, so identify common areas and identify the work which has been divided. Okay, in the plan we have to identify. Second, ascertain the reporting objectives. What do we have to reporting objectives? What do we have to report about? Let's say whether we are doing is it an income tax audit or is a company audit? When do we have to report, and accordingly we'll plan, right? So what is the reporting objective that you have to decide to plan the timing of audit, so that the entire planning of the audit can be done, so that the entire timing of the audit can be done. Ascertain the reporting objectives. Okay. Third, consider the factors that are significant for the entire joint audit. What are the factors that can be significant? We need to consider it, and we need to communicate amongst all the joint auditors. So all the factors which are very important for the conduct of joint audit should be mentioned in the plan, and it should be obviously communicated amongst all the joint auditors. So if you can see, I have written here also, communicate amongst all the joint auditors. And consider preliminary engagement activities. What can be the preliminary engagement activities? Preliminary engagement activities means we need to ensure, obviously all the joint auditors, they need to ensure whether they are complying with the ethical requirements, whether they are independent or not, whether audit engagement letter and all has been made or not, all these things. Okay, so we call it as preliminary engagement activities. This word you are going to cover in essay 220, also the only standard that is left after this particular standard. Okay, so third point, consider, rather, there shouldn't be third point here. If you go by the standards, okay, this becomes your third point, this is your fourth point, and this is going to become your fifth point. So we are going to consider all those factors that will be significant in the audit. Okay, next we are going to consider the preliminary engagement activities. If you want to write preliminary engagement activities, like I can say ethical requirements, preliminary engagement activities. Engagement means work. Okay, so before accepting the work and all, we do something, right? So we need to check on our ethical requirements, we need to ensure independence. Okay, then audit engagement letter, if you remember, as per 210, all these things. Okay, these will amount to preliminary engagement activities. And to do the audit, to do the entire audit, we need to plan how much resources will we be needing, what amount of time will we be needing, how many articles, how many audit staff will we be needing. So these are the 5 points. Okay, please mark it as important whenever you take it down. They may ask you a direct question that what are the points to be considered in joint audit plan. Okay, in joint audit plan. So first point, please remember this, that the common audit areas and the work which has been divided will be basically identified. Second point is what? You need to consider your reporting objectives, so that the timing, the nature of the audit procedures can be finalized. Third is, consider the factors which are really significant for the entire audit, so that the same can be planned and communicated to all the joint auditors. Next point, consider the preliminary engagement activities, and finally ascertain the resources that would be required, the time that would be required to complete this audit. So this is what we consider while we draft a joint audit plan. Okay, now please understand, we are covering 3 words here. I am on the requirement number 1, if you all can see, audit plan, then risk assessment, and allocation of work. Okay, did I tell you, you all know that ROMMS, ROMMS is done before planning or after the planning? Don't you think as per ROMMS you make the audit plan? Yes or no? You assess the ROMMS and accordingly you make the plan. So we have to assess ROMMS here also. So ROMMS to be assessed by each joint auditor, to be communicated to other joint auditors. So let's say 4 joint auditors, we have given them the work of 4 different areas, north, east, west, south. So each of the joint auditor will assess their relevant internal controls and ROMMS. They are going to assess their own ROMMS, and whatever ROMMS they assess, they are going to communicate to all the other joint auditors. This ROMMS needs to be documented also. Okay, so what I'm trying to tell you, again, let us read from the text here. ROMMS to be assessed by each joint auditor, to be communicated to other joint auditors. It has to be communicated to other joint auditors, as well as it has to be communicated. It has to be documented. It needs to be properly documented. Okay, then joint auditors shall obtain common AEL. Now all the 4 joint auditors, they will not obtain different AELs. One common audit engagement letter will be obtained. Okay, All right. Now, final point in this allocation of work. Again, allocation of work is also important. So this is an important question here, that what are the factors to be considered in joint audit plan? And the next important question is allocation of work. Very simple point, allocation of work. Now, who is going to do what work? All the joint auditors, they are going to decide it on a mutual basis. They are going to have a mutual discussion, and then the decision will be made. Okay, I'll be doing this, I'll be doing that. Okay, on what basis can they divide their work? They can divide their work on the basis of areas, like I told you, north, east, west, south. They can divide it in this way. They can divide it as per the units. Let's say they have, the company has got 10 different divisions or units. So 3 divisions will be taken care by me, 3 divisions will be done by him, whatever it is. So as per the number of divisions, as per the number of units, can the work can be divided. Okay. Third is on the basis of expertise. Let's say there are 4 auditors. This particular auditor tells that, okay, he's really very expert in determining, let's say, checking on the expenses with respect to manufacturing costs. So we will allocate him to check the expenses. So on the basis of expertise of the auditors also the work can be divided. Okay, and then we have on the basis of items of financial statements. Now let's say it is not possible to divide the work on the basis of north, east, west, south. Let's say, okay, so then probably we can divide the work on the basis of the items of financial statements. 4 auditors. Okay, first auditor, you check the assets. Second auditor, you check the liabilities. Third auditor, check the income. Fourth auditor, check the expense. This way also we can go. Right, and let's say if there are more auditors in expense also, these are the items which this particular auditor is going to check. So division of responsibilities, division of work can be done in any of these ways. Okay, but now please be very careful. Now when this division of work is done, okay, there can be dispute or there can be confusion later. So it is better, once the division is done, it needs to be documented. It should be documented so that it is in record. It is kept in record in writing, and it is available with all these joint auditors, so that in future there is no confusion, there is no dispute. All right, and the same division, on whatever basis or criteria we have divided, we have allocated our work, the same needs to be communicated to TCWG also. So if you can see here, these are the criteria on which the division of work can be done. So I have written here, document. It should be documented. The criteria, the work once divided, let's say it should be documented. Why? To avoid dispute or confusion. Okay. And at the same time, the same needs to be communicated to TCWG also. They should also be knowing that which particular auditor will be checking which particular area. So once we divide our responsibilities, the same needs to be communicated to TCWG also. All right, and it is up to them. I told you it is not necessary that all the work would be divided. So some important areas, let's say, they might decide to do it collectively together, right? So certain areas of work, owing to, let's say, importance, may not be divided also. All right, so this is how work can be allocated, work can be divided amongst the joint auditors. All right, so we are done with the first requirement. Again, let me tell you, only 2 questions. If they ask you questions from this area, 2 questions that you have to remember. One is, what are the factors to be considered in developing a joint audit plan? And secondly, they may ask you a question on allocation of work, how the work can be allocated and on division of work. All right, so still, these points that we have covered is really very simple. You should be knowing that when they develop a audit strategy, all the auditors, all the joint auditors should develop it. Okay, they should be involved when they are making audit plan. So engagement partners and engagement team members from each of the joint auditors firm should be involved, and they should come up with a joint audit plan. Okay, when they have made the joint audit plan, what all things they should be considering? Common audit areas, the work which has been divided. Okay, then what are the reporting objectives, any significant factor which is really going to be important for the audit. Okay, preliminary engagement activities. Then finally, how many people, how resources, the quantum of resources that will be needed to execute the entire audit. Okay, then ROMMs will be assessed. Now let's say we have 4 auditors, we have divided the work, so they are going to assess their individual ROMMs, and they are going to communicate the same to all the remaining auditors as well. All right, and they need to document the same. And last point is, joint auditors they can obtain a common audit engagement letter also, no problem about it. Now allocation of work, we have already discussed this. All right, so this we are done with the first requirement. Now let us start with our second requirement, responsibility, and 2 words, responsibility and coordination. Responsibility and coordination. Now please understand this way, in this manner. Let's say we have 4 auditors, A, B, C and D. All have been given the responsibility, but they have been assigned some work. A is given north division, B is given south, east, west. Okay, now Who is going to be responsible for the north division now? Please understand, when the work is divided, the work has been divided. So the firm which has received the work will be obviously responsible for that particular area. If we have divided the work division wise, if we have divided on the basis of financial statement wise, so firm A will be, let's say, responsible for checking of the assets. So when I talk about responsibility, the individual firms will be responsible for the work allocated to them. Okay, individual firms will be responsible for the work that has been allocated to them. But we have just read that, sometimes all work is not divided. We have just heard certain areas of work may not be divided. So for those work which is not divided, what do you think about the responsibility? Don't you think all the auditors now will be responsible for the work which is not divided? Yes or no? Yes. So please understand, I have two topics to cover here: responsibility as well as coordination. So when I talk about responsibility, it is going to be of individual responsibility, when each joint auditor shall be responsible for the work allocated to such joint auditors. This means when there is proper division of work with respect to that work, that single joint auditor will be responsible. Okay, but let's say the work which has not been divided, then in this case, what is going to happen? The responsibility will be joint, and all the joint auditors will be jointly and severally responsible for all those work that has not been divided. Okay, so when I talk about the common area is the responsibility. All the joint auditors are jointly and severally responsible for the common areas. Are you able to understand this? Are you all with me? Yes? All right. Okay, so this can be another important topic that discuss about the responsibility of the joint auditor. So you have to understand that, you have to write that for the work which has been allocated to each joint auditor, that particular joint auditor will be responsible for the particular work which has been allocated to him. So there it is going to be his individual responsibility, right? But let's say for the work which has not been divided, all the joint auditors are going to be jointly and severally responsible. Okay, but there are some other cases also where all the joint auditors will be jointly and severally responsible. What are the cases? Let us discuss this. This is an important topic. So for the work not divided, I hope you are clear on this. Now, for the decisions taken for common areas concerning nature, timing and extent of audit procedures to be performed by each joint auditor. So for the work which we have not divided, obviously we all will be jointly responsible. But let's say this is a common area. This is a common area. Okay, and in this common area also we decide that, okay, this will be done by you, this will be done by me, this will be checked by me. We all will be involved. Okay, but okay, please check this part. One auditor will be doing this part. C auditor, let's say third auditor, will be doing this part. Now what is going to happen here also? The responsibility will be joint, and all the auditors will be responsible here also. The point here is decisions taken for common areas concerning nature, timing and extent of audit procedures to be performed by each joint auditor. The procedure will be performed by one auditor, no doubt about it. But any decision which is taken with respect to the common area, all the auditors will be jointly and severally be liable. Okay. Now, third point: matters which are brought to the notice of joint auditors by any other joint auditors, plus and they agree, and all agree. This also should be a point here. Okay, so what I have read here: matters which are brought to the notice of joint auditors by any other joint auditor. Now please understand, let's say Mr. A, he was auditing the North Division. He comes across a situation and he informs about it to B. Okay, so any situation, let's say matters which are brought to the notice of joint auditors by any joint auditor. Okay, so joint auditor A and company, he informs certain aspects to B and company, C and company, D and company also, and they all agree to it. Now when they have all agreed to this aspect, then it becomes a joint liability. Okay, now individual liability will not be there. It becomes a joint liability. Okay, then presentation and disclosure of financial statement. Anything with respect to presentation of and disclosure of financial statements will always be a joint responsibility. You cannot ask management to prepare different sets of financial statements catering to the different requirements of the auditors, right? So when it comes to the presentation and financial disclosure of financial statements, these auditors will be jointly and severally liable. I told you that they are going to issue one audit report. Generally, they are going to come up with a unanimous report. That means all will come to one particular opinion. All right. So when they give an audit report, so they need to ensure that they have done their audit in accordance with the standards on auditing. They have complied with all other relevant statutes. Let's say companies that they have complied with section 143.3, they have complied with section 143.1, they have complied with the requirements of CARO under 143.11, all these things. Okay, so all, when they issue a common audit report, all of them will be obviously jointly and severally liable for it. Okay, so they may ask you the question, they may ask you, when will the joint auditors be jointly and severally liable? So first thing is for the work not divided. Second, for the common areas which the decisions which they take with respect to the, let's say, application of audit procedure on the common areas, everyone will be liable, irrespective of the fact, let's say, that this particular audit procedure is performed by C and company, but everyone will be responsible. Okay, then matters which are brought to the notice, A and company, he tells B, C and D and company few things about the company, and all of them agree, so this is again becomes a common matter. Okay, each one of them will be jointly and severally be liable. Presentation of disclosure of financial statements, and last we have audit report. Okay, so this is a point with respect to responsibility. It is an important topic, and again, don't you think these auditors will have to work in coordination? Let's say I was doing the audit in North Division. I found let's say some abnormal transactions in North area with respect to purchase. All right. Now I feel that, okay, this is a practice which is followed by the company. It might be in South area also, in North area also, in West area also, East area also. So I inform the respective auditors. I inform my other joint auditors. Okay. So please understand coordination. What I have written in course of audit. If a joint auditor comes across matters which are relevant for other joint auditors, if I, while doing the audit of North Division, I come across a matter which is relevant for the South Division, it is my responsibility to communicate the same to the joint auditor of the South Division. Okay, so in course of audit, if a joint auditor comes across matters which are relevant for other joint auditors, the said joint auditor shall communicate the same in writing to all joint auditors prior to completion of audit. So it is my responsibility to coordinate, to maintain coordination amongst all the joint auditors. I hope you are clear on this. Again, let me give you an example. While doing the audit of North Division, I come across some information which is relevant for the South Division. It is my duty now to communicate the same to the South Division auditor. Obviously, when should I be communicating? Not after the audit report, before the completion of the audit. Is this clear to everyone? Yes? Alright. Now let's come to the last requirement. How are we going to give the audit report? So audit conclusion and reporting. So all these joint auditors, all these joint auditors are working in coordination with each other. They have made plans and everything. So generally they come up with a unanimous audit report, unanimous opinion. That means if A says, okay, I want to give unqualified, B, C, D will all come to a unanimous conclusion or opinion. Alright. So the point here is, in case of audit conclusion and reporting, generally common audit report is given. Common audit report is given. Common audit report, as in I can also write the word here. They come to a unanimous opinion. Generally. This is why I have used the word generally. But however, in case of disagreement, there can be disagreement between them. Disagreement as in not a fight, but let's say one of the auditor, he feels that no, this is a matter of significance. Again, let's say it should be qualified. The other auditors are of the view that no, this is not something very material, we don't need to qualify. In this case, what is going to happen now? So let's say there are 4 auditors, 3 say unqualified, 1 say qualified. So the one who is left out, that let's say auditor number D and company, he is not bound by the opinion of the majority. He can give his separate opinion also. Please understand this. Okay, generally what happens in case of joint audit, there is unanimous opinion. Okay, but there might be some disagreement also. D and company is not agreeing to what A, B and C feel. Okay, so in that case what can happen? However, in case of disagreement, separate opinion in separate audit report can be given. Separate opinion in separate audit report. So how many reports will be there now? In my example, A, B, C, they are, let's say they want to give clean opinion, D wants to give a qualified opinion. How many audit reports will there be now? 2. One will be signed by A, B and C. The second one will be signed only by D. Right? So there can be 2 audit reports. So the auditor who is disagreeing to the remaining auditors, is not agreeing with the other auditors, he can give a separate opinion in a separate audit report. Okay. Now, a joint auditor is not bound by the views of the majority. I told you that there are, let's say, 4 auditors, all 3, let's say no, unqualified. So he's not bound by their views. Again, I told you there is a lot of professional judgment involved while we give our opinion, while we apply the procedures. So he may think of giving a qualified opinion, he can very well go ahead with it. He is not bound by the opinion or views of the majority. Okay. And in case of separate reports, but yes, what is going to happen? Let's say now these 3 together will serve one, they'll give one report. okay, and he is going to also, they are also going to issue one report. But now, because there are two audit reports, each of them need to mention in their OM paragraph that there is one more report. They are of this view, there is one more report, let's say, okay. So in case of separate reports, reference in OM paragraph. OM is other matter paragraph. If you remember, I told you other matter paragraphs is a paragraph which contains details of those things which is not there in the financial statements, and it basically let's say, we put in details with respect to our audit procedures or audit report there. So OM paragraph, you need to mention this, all right. And one more thing, okay, now let's say all of these joint auditors, there are three joint auditors, A, B and C. They are going to sign the audit report. This is the audit report. They have given a common audit report, and the joint audit report will be signed by all the three auditors. And here in this case, it will be signed by another auditor, let's say D. Okay, what I'm trying to tell you is, now let's say A has checked the north division, B has checked the south, east, west. So should A be relying on the work of B? Should A be checking the work of B again? So the answer is no, because all of them are chartered accountants. A joint auditor is not required to review the work of another joint auditor. Okay, ordinarily, because they are chartered accountants, you are going to place reliance on them, right? So last point to consider in this standard, a joint auditor need not review the work performed by other joint auditors. So one joint auditor need not, they are simply going to accept, they are going to place reliance, they are going to trust the work of other auditors. This is what I mean to say here. Okay, so we are done with the standard. This was with respect to audit conclusion and reporting. Yes. A joint auditor is not bound by the views of the majority. This means, again, let me give you an example. We have 4 auditors. 3 wants to give unqualified opinion. Okay, so these 3 are of the view that no, unqualified opinion is okay, but he is not bound by their views. He shouldn't be bound by the fact that okay, 3 of them are saying maybe I am only wrong. No, not required. If you are sure, if your professional judgment tells you that no, a qualified opinion is required, you can issue a separate report. So this auditor here, auditor number D, is not bound by the views of the majority. He is not bound by the views of A, B and C. Got my point now? Alright, so again, this is what SA 299 is all about. A very, very small standard, but again, let me tell you, if they ask you a question, they may ask you what are the points to be considered in joint audit plan. First question, allocation of work, they can ask you a question. Responsibilities is what I feel is important. So entire responsibility is important, not just this part, but you need to cover the entire responsibilities part. Okay, and finally, when it comes to reporting, you all know this, they generally come up with one report. But in case of disagreement, they can have their own opinion in their own audit reports. Okay, so one joint auditor is never bound by the majority. All right, and finally, fourth point is we generally trust the other joint auditors. It is not required for us to view their work, review their work, okay, before signing the audit report. So this is entire 299. Now, any doubts if you have, please ask me now. Yes. No, this will be a part of the entire report.